Welcome back to the show. Today, we're diving into a critical yet often overlooked topic in divorce proceedings, business valuations. Joining us is Matt Springer, an expert in business valuation and litigation support. With nearly 20 years of experience helping individuals and attorneys navigate the complexities of valuation during legal disputes, including divorce, Matt is a director at Vision Point Capital, where he provides valuation services for a range of purposes, including matrimonial dissolution, divorce, shareholder dispute, tax planning, and more. His extensive credentials include a lot of letters that I can't even get to. Speaks to his expertise and dedication to his field, whether it's evaluating a closely held business or untangling complex financial details. Matt specializes in helping clients understand the true worth of their assets. If you're a man over 40 going through a divorce and wondering how business valuation impacts your case, you won't want to miss this conversation. Let's get started. Introduce yourself, Matt. We'll go from there.
Thank you. I think you did a great job. So I'm Matt. I'm over 40 and I do business valuation. It's what I love to do. I've been doing it. I was fortunate in this field. A lot of individuals find their way here. And it was my capstone course at the University of Texas, Austin, when I was a senior, basically a valuation class. And I was like, this is it. Why wasn't this offered at the beginning of my school journey? But went straight into valuation and been doing it ever since. So it's a pleasure to be here today and looking forward to the conversation.
So what do you think the business valuation is such a critical component in divorce cases?
Yeah, it's a business in a case. It's usually one of the largest marital assets. And unlike a house or a publicly traded stock like ExxonMobil, like there's no price tag on it. And so what does that mean? It means that you have to provide an opinion of value of what it is. And when you're determining what the value of a business is, you have to think about the ownership interest. Is it community property? Is it separate property? And then when you're actually getting into the weeds of trying to value the business, it's really pulling all of the economic, market, industry information that you're researching and making judgment calls on to determine and develop a value of a business. And it can be a very complicated process. And so you bring in experts to provide those opinions, and you want to make sure those experts have the experience and have even covered in the same industry that your business is operating in, so that you're getting a professional that's seasoned and knows about the business and what drives it.
What are some of the basic but key factors that influence the value of a business in divorce?
Yes, really, a tax return is a historical record, right? And it's certainly an important element that you want to consider. But what we're really trying to do in evaluation is, what does the future look like? And so we take those historical tax returns or financial statements that you have, and we begin what is a normalization process where we are looking to, say, owner's comp. Not every single owner pays themselves a fair market salary. Some don't take a salary at all. And when you think about a hypothetical buyer coming in, they ultimately have to determine what is a reasonable salary that they would pay themselves if they took over the business and was managing it. And so we make those sorts of adjustments, and other adjustments are similar, like related party rent. Maybe you own in a dental practice, you can have your real estate owned in a separate entity and you charge it rent. We just want to make sure that rent's at a fair market value. And so we'll go through those normalization adjustments and also be looking for extraordinary amounts or one-time expenses. Maybe there's legal expenses in a certain year that aren't regular. We just want to add all of those back or make adjustments as needed so that we can get to a cash flow that ultimately is representative of what the business can earn. And then we factor in what growth expectations are, if there's customer concentration issues, and we're discounting all of that back to the present. And so that's just one approach, but that is certainly how we're approaching the business valuation in every single case.
What are some of the biggest misconceptions people have about business valuations during divorce? I know there got to be some misconceptions.
Sure. Yeah. There's quite a few. I think that really the individual that's performing, right, they have to make assumptions, and it's kind of garbage in, garbage out in terms of the information that's provided. And so if you give me great information, I'm going to make great assumptions around that information. But if you give me bad information, then I'm left to, okay, I have to make a judgment call. And so oftentimes what I'll find is maybe I'm working with a non-spouse owner, like that's the client that hires me. And so I'm going to provide an evaluation, but let's say the spouse that's actually running the business, like they don't want to give me information. If you don't give me any information, all I have to look at is this historical record, and I have to make assumptions that what's the future look like. And so maybe you've lost a huge customer, but because you haven't told me about it, I don't know about it. And I'll include in my report that, oh, assumptions been made because I haven't had access to management, or extraordinary assumptions been made, and I'll adjust my opinion accordingly. And so when you get to the trial and the trier of fact is asking me questions, why didn't you take this into consideration? The husband wouldn't work with me. The wife didn't work with me. And so while the judge ultimately is going to make a call in terms of what he thinks is reasonable, he knows I worked with the best facts that I had in front of me.
Wow. Can you explain the difference between fair market value and fair value in the context of divorce? And why is there a difference?
Yeah. So you said fair value. Is that what you asked?
Fair market value and then fair value in context of divorce. Some people say there's a difference.
Sorry, if you could ask that one more time, you broke up.
Can you explain the difference between fair market value and fair value in the context of divorce?
Oh, sure. Yes. So depending on what state you're in, there's different jurisdictions, and case law takes precedent. And so in Texas, for example, it's a fair market value statute, which means that you're basically thinking about a hypothetical buyer and a hypothetical seller coming together, and you're ultimately going to enter into a transaction. There's no compulsion to enter into the transaction, and both parties have reasonable knowledge of the facts. And so you're now taking that construct and you're saying, what is the fair market value of that investment? And fair value, depending on the litigation context and the jurisdiction, it can have different meanings at different places. But in some cases, they will say that fair value does not have discounts for lack of control and marketability. And those are discounts effectively for the fact that if I'm own 10% of a company and I don't have unilateral control, I can't make decisions, a small incremental discount or a large incremental discount can be applied for the fact you don't have control. And then also marketability. If it's not a publicly traded company, right, like an ExxonMobil again, then we can look to studies and empirical data to determine what is a reasonable discount for lack of marketability. And so in fair market value, you usually apply those discounts, and in fair value, you do not. And so it just depends on, you have to know the states and the cases, the history, in order to determine how to approach it. But in all cases, that's an attorney decision. They'll tell you at the front, like at the forefront of the engagement, this is how we approach value. But it's important for the listeners to know if they've got a business, right, the very first thing that they want to probably look at is just some research in terms of what is the standard of value in the state, in this jurisdiction that are going through a divorce in, because it will tell you.
Oh, good. What role do tax issues, that's a big one that people worry about. What role does tax issues play in the valuation of the business during divorce proceedings?
Yeah. So most of the businesses we see are privately held, right? Maybe they're pass-through entities like an S Corp or an LLC, and they don't pay taxes at the corporate level. They'll pay taxes at the individual level. And so when you think about taxes, you would think that you'd be valuing this business, and taxes wouldn't be necessarily a part of that because the business doesn't pay taxes. But in valuation, what we're doing is we're looking to publicly traded companies that are paying taxes as measurements for what is the value of this company. And so if we're building up, say, a cost of capital that we would be discounting our cash flows back to the present, that cost of capital is based on publicly traded companies that are paying taxes. And so in order to get a valuation on an apples to apples basis, you actually have to tax affect your earnings. And as you're projecting them, tax affect them as well. So taxes at a corporate level, oftentimes you will see a entity that, even though it's passed through, have an effective tax rate that's incorporated in the analysis. And then individual taxes, those are obligations that you would need to be estimating. Maybe you need to put it on your inventory listing and letting your attorneys know that there's transaction costs and expenses, and these are the estimated taxes that at the end of the divorce you'll have to pay those. And a good attorney will help walk you through what that inventory should look like and help them answer those sorts of questions.
So how do you handle situations where one spouse tries to overvalue or undervalue their business? Do you have any teeth in that respect?
It happens fairly often. It's really just after doing this for so long, it's a conversation that we're having, and you can see by the information that's provided, that's not provided, how defensive maybe the answers are during a management interview, how open to being credible, and how honest and trustworthy you find those answers. And then you're basically taking all of that data and you're measuring it against what they've done to see if it checks. But I think that the most important thing is I'm not just interviewing the business owner. I'm going to try to interview the spouse and hear about how they worked and what hours did they work, what were their challenges that they talked about at the job, and what are the strengths of the business. And then I'll also be going through actual key people at the business itself, whether that's managers or C-suite individuals. We try to have as many relevant interviews that we can so that we can hear the entire story and the narrative of the business. So when it comes to the judgment process, we get enough information that we can make those assumptions and judgments appropriately.
What's the importance of assessing intangible assets like brand reputation or goodwill in a business valuation?
Sure. So that's going to be another jurisdiction related item, right? Depending on what state you're in. Here in Texas, when you get divorced, the personal goodwill, which is basically your time, talent, knowledge, relationships, expertise, it's not divisible. And so you go through this valuation of a medical practice and you get to the end result. There's going to be some element that is intangible assets, which will be both enterprise goodwill and personal goodwill. Because the personal goodwill is not separable in divorce, we have to basically allocate that and determine what is remaining is the enterprise goodwill. And enterprise goodwill is the trademarks, the brand name, the customer relationships, customer database, all the website, all of those things that the business owns that can be divided in a divorce if the state requires us allocating personal goodwill between enterprise goodwill. And so it's a difficult process, but it's certainly an area where assumptions are made. And so what I found just doing this for the number of years that I've done it is you want to hang your hat on as many information items as you can when you're making that allocation and have a basis for whatever that assumption may be that's grounded in market evidence. So it's not just because I said so, it's because based on the conversations that we've had and the narrative that I've learned and the information I reviewed, these are the factors why I believe this allocation should occur this way.
So what is the role, or is it different roles for the valuation expert when they're in mediation or depositions or trial preparation? Is it the same role or is it different roles for all three?
It's different, but same hat, right?
Okay.
The earlier you bring in an expert, the better, right? Long before trial, because attorneys are great at what they do, but they hire the experts they need for a reason. When you bring an attorney or when you bring a business valuation expert on, you are giving them the opportunity to start at the beginning of the case, which means that the information request that they prepare can be very helpful in the discovery process. Instead of sending over 1,000 items that we need for, and that the attorney may think they need for a business valuation, using my experience and tailoring that down to the industry, to the type of business, the size of business, that I can really be strategic in terms of what we're requesting. And then also just the review time that it would take me to go through some of these complex documents, like I can help the attorney out. But that's on the front end. And then obviously as we're going along, I'm going to perform the business valuation. But where it becomes a little bit more strategic is when there's another opposing expert involved and they have their own valuation. I can basically take that valuation that they've done and surgically take it apart and tell you where their weaknesses are, if they've got errors, if they are duplicative in terms of assessing value in multiple places, how they're approaching their valuation. And does it fit the narrative and story of the business? And so that's the real fun part for me anyways, is getting in there, seeing someone else's work and helping other people understand it and how to utilize it.
Well, slapping around a little bit. And my next question, how can divorcing spouses ensure they're hiring a qualified and experienced valuation expert?
Sure. So the alphabet soup, right? That's maybe a starting point, but it doesn't tell the whole story. You want to make sure that they have a valuation credential and they've got the experience to be able to do this. Litigation is just a different animal, and I really do think that you want someone with experience. It doesn't mean that people that have a valuation credential can't do divorce-related or litigation support work. It's just the lessons that you learn along the way, right? That's the real expertise is you know what the judge is looking for, you know what a credible assumption is, and most importantly, you do divorce valuations. And so it's a lot different than if you think about just, okay, this individual does valuations, but maybe he does it for mergers and acquisitions. That's a different hat that you're wearing instead of kind of the strategic hat that you have to wear in a litigation or a dispute related matter.
So what's the difference between what you do and what a forensic accountant does?
Sure. A forensic accountant will basically go in there and maybe if there's elements of fraud or tracing,
Okay.
they're going to go in and be looking to their bank accounts, following the money, and then they'll be providing the legal precedent in the state and jurisdiction to the facts and circumstances of the case. Maybe there's personal and community property that has to be figured out. So the forensic accountant will be slotted into that role. And I would work usually in conjunction with them, right? They usually provide their opinion first. And then once the attorneys know which entities need to be valued, that's when they'll bring the business valuation expert in and I'll get to work.
So generally, without naming names, what is some of the craziest stuff that you come across over the past years? You got some stories. Come on, give it to us.
Sure. Yeah, well, I'll tell you, my first job was for a major league baseball team and was doing the valuation for them and sat down with the owner and he just started telling us stories about the players and the mischief that they got in. The night before, there was a hot tub and a player walked straight through the glass and cut their hands all up and was going to be out. Amazing just to hear the narrative and what's happening in a business. So you get to see industry by industry, the humorous stuff, and also really what's driving the power grid in Texas and what are the weaknesses and how are they going to resolve it. So that's the fun side of it, is just the learning. But there's just individual, and the divorce process kind of opens up a relationship and all of the crazy that happened in that relationship gets brought to the surface. And so we unfortunately get to see some of the worst of relationships, but at the same time, I'm not here to pass judgment on any of that. I'm here to help an owner figure out what their value is so that they can separate and go their separate ways. And I think just I'll end with doing it while not being an advocate for either party, doing it being truly independent and objective, because that's how I know I'm doing my job correctly, is if the outcome is, I believe, truly fair. And it usually means that both sides aren't necessarily happy with the end result, right? There's some pain along the way to get to a brighter future, but it's work that's interesting, it's complex, and it's what I certainly love to do.
So with the advent of COVID and internet, how do you evaluate the internet business? My daughter is a Instagram influencer down in Austin. How does that work? Because you can't put your hands on it. How does that work?
So it's a unique business model, but what you would want to see is if there's any sort of revenue that's associated with the business itself. All right. Does she have some sort of brand deals? Is she a brand ambassador? How is she monetizing it? And once you understand how it's being monetized, then you're just looking to, okay, what are the cash flows telling me? Is this reoccurring revenue? Is this one time off, right? And that new deals are needed to be secured. So you really have to understand kind of the dynamics, the driving force of how to monetize it. And then what's the purpose, right? What are we valuing the business for? Because it really does depend or change how we may approach the value just depending on what the focus or the goal is. And then I'll just say lastly, like if she was going through a divorce, right? If she is the face of her business, right? Like for you, for example, you're in a podcast business. If I were to value your podcast, if it was being monetized, I would look to your personal goodwill if I had to allocate between enterprise and personal goodwill. You're the show, right? So you naturally would think that's going to be pretty high. So we go through the fact pattern of trying to figure that out. The same can be said for your daughter. Is she the sole face? Is this for divorce? Do we need to make that allocation? Because if we need to make that allocation and it's not divisible and if it would be her separate prop on divorce, then that ultimately would have to be taken off the table in terms of what the value is.
Gotcha. So back in the day, back when I was in dental school, back in, God, 84, 87. So back when you were a wee lad, remember this one term that they just hammered in our head. It was blue sky. What the hell is blue sky?
Yeah. So it's basically a value, like a rule of thumb,
Yeah.
and is just a multiple that you apply to some sort of earnings metric, and it has different connotations for different industries. But like in an automobile dealership industry, there's this notion of blue sky, and you can value a business looking to the future cash flows. We can go out and maybe find some transactional data and value it using a market approach. But in specifically the auto dealership industry, there is pretty good information on blue sky value. And so there are valuation experts that will look to it. And it's just basically rules of thumb for different brands, right? And BMW versus Ford. And what's that blue sky multiple trading for? So I would just end with, it really is a dangerous metric to use. So you don't know what you're applying it to, right? If I say EBITDA to you, and maybe in a particular industry, everyone hears 5 times EBITDA. What is EBITDA, right? We have to define it. And we talked about some of those normalization adjustments being made, right? Is it 5 times before those normalization adjustments are made? Is it 5 times after those adjustments are made? And then you come over to the 5 times multiple. If you're applying that consistently to every single business that you're valuing, what if a company is doing 200% growth in sales every single year versus another company's walking backwards? Are you applying it 5 times to each one? So it's really both a definition and is it fair to apply just a 5 times standard kind of multiple to anything?
Yeah. So when did you get the valuation bug, the business valuation bug? Were you an undergrad, grad, high school? When did you feel that?
I wasn't always a valuation nerd. Once upon a time, I traded baseball cards when I was younger.
Most kind of the same thing.
It is, yeah. There's that standard of value would be investment value, right? What is this value? And you also need to consider like personal investment value, like what is the value to me holding this player that I know that I love versus someone that lives in Milwaukee and doesn't know who that player is at all. But yeah, no, I think that it was definitely in college. They make you take some finance portfolio theory classes and accounting classes, and those were certainly interesting, but the valuation puts it all together. And so I think what I love about my job so much is so many people went to undergrad and they don't utilize what they learned from their undergrad, and I utilize all aspects of it every single day. So it's been a fun journey, and as long as AI doesn't take over my role, I could be the
AI practice valuation. Oh man. Finally, what's the most important takeaway you like our listeners to remember about your business valuation in divorce?
Sure. Yeah, no, I think that credibility is paramount. Evaluation is only going to be as good as the assumptions that are made and the information that's received. And so that's really important that you give great info, try to be organized, right? You can send a whole bunch of documents to your attorney and you can pay them a very high hourly rate. And you can also pay me a very high hourly rate to go through those documents just to have them organized. If you've got tax returns, if you've got financials, put them in a folder, right? Separate folders. If you've got the organizational documents, put that in a folder so that you can share this and the attorney isn't having to go through each one, trying to categorize and understand. And so really that's, I think, the biggest thing that I can suggest for somebody that's going through this. We talked about it a little bit prior to recording, is just the journey in a litigation matter is something that you can't really control unless you come to a settlement. And trust your experts, hire a good attorney, and if you've got questions, like that's the reason that they're there. Don't be reluctant to ask a question about evaluation that you don't know. Look at the valuation work, ask questions about the assumptions that are being made, and make sure that your fingerprints on the valuation, because if you just take it wholesale and really don't ask questions, it's going to be assumed by all parties that this is the facts of the case and this is what the opinion is. So definitely ask questions, and I'll just end with better information, better settlements, better outcome. That's really the key.
There you go. And where can my men find you on the internet? And I'll have those links on the show notes.
Sure. So I'm at Vision Point Capital. You can reach out at matt.springer@visionpointcapital.com. And my cell's 832-727-0336.
All right, Matt, you knocked out the park, man. That was fun. I learned quite a bit. Like I said, where were you 15 years ago? All right, man. Hey, thank you very much for hanging out with me on a Friday morning. I really appreciate it, and my listeners do too.